How do you compete with a cash offer in a hot market when you need a loan? That's what we're going to talk about today.
I'm John.
And I'm Alyse.
And we are with the Heart of Austin Homes team, a ninja team of real estate agents here in Austin, Texas. And we help buyers compete with cash offers all the time.
If you guys like cash or just buying houses, please hit the little like button. And then if you want to see about our next video, please hit the little bell. And we would love it if you subscribed. And if you have comments, put them down below.
Where they go. So there are three main reasons that a seller would choose to go with a cash offer instead of an offer that came with a loan.
Number one, speed to close. So a lot of times a seller needs that money sooner rather than later. Maybe they've even been working on prepping the house for a few months and they need that money as soon as possible to be able to buy their next house or to get out of debt or to get out of Dodge or whatever their thing is that they need to be gone from. They may need that money sooner rather than later.
I mean, just think about yourself. When you need the money, how soon do you want it? Like yesterday.
Yesterday.
The second reason the seller would choose a cash offer over an offer with a loan is that there's no appraisal. So an appraisal always kind of throws a little bit of a wrench into the works, especially when houses are being bid up and the prices are increasing in your market. So without an appraisal, there's no one to say, hey, they don't value the property right, so they want to negotiate the price back down. It's just, hey, here's cash, so the buyer has to be their own underwriter, and that just goes away.
Definitely. And when you get a loan, you are required to get an appraisal.
Yep.
In general. Every once in a long while they won't if you're putting down like 50%. But almost all loans require an appraisal, right? And if that comes in lower than the agreed upon value because it's an appreciating market, then the lender will only lend whatever percent they were going to lend you on the appraised value. For example, say you agree to pay $500,000 for a house and the appraiser comes back and says it's only worth $450 because he's basing it on past comparisons. Well, the lender now will only lend you whatever percent they were going to lend you, say 90% of the value of the house on $450. So there's a $50,000 gap between what you have said in the contract and what the bank will lend on.
So guess who has to bring that extra cash to the table?
Well, it's a toss-up. In this market, it tends to be the buyer.
That's right.
In a normal market, it would go back and forth between whether the seller came down or the buyer brought that extra cash or somewhere in between. This is not that market.
Yeah, and so that's why a seller, in many cases, would choose a cash offer instead of one with a loan because you just don't have that headache.
Number three is a financing contingency. So the appraisal is about whether or not the house is worth the value in the contract. The financing contingency is whether or not the buyer is going to qualify for the loan.
How good of a person are you really?
Our lenders tend to not give out pre-quals unless they're pretty darn sure that they are going to be able to give you a loan. So the chance that that's going to fall through are pretty low. But it is not outside of the realm of possibility for a buyer to think that they're going to be able to get the loan and then either something happens to their credit or something happens to their income.
Or they make a big purchase in the middle of their transaction.
Which screws everything up.
Yeah,
don't do that.
Don't do that.
And then they no longer qualify for the loan. Without a financing contingency, i.e. without you needing to qualify for the loan, the seller just knows that a cash offer is able to go through because they have verified that that person has that cash in the bank somewhere.
Just makes it easier.
In general. Why do you think that a seller would choose to go with a cash offer over a financed offer? And how do you think a financed offer can compete best with a cash offer? Mention it in the comments below.
So if you still require a loan like most other mortals, here's how you compete with those cash offers. We're going to go over those same three reasons, but how you compete and with a fourth bonus if you stick around.
Number one way that you compete as a financed offer with a cash offer is a fast speed to close. So normal in a balanced market is 30 to 35 days for a closing time. I've seen them up to 60 days. It was normal before this current craze in this market to have it down to about 21 days. And most lenders, if you push them, can get it between 20 and 25 days. The best thing you can do is get all of your documents into your lender as early as possible, so they're as far through the underwriting process as possible, and mostly they just need to focus on appraisal and any secondary documents that their underwriter needs from you.
So this makes that finance offer kind of close to a cash offer because you're shortening the finance window as much as you can. Now, it's really important to choose a lender that can do this because not all lenders are created equal, so you want one that can move fast.
Definitely. And a cash offer, let it be known, can sometimes close in as short as 7 to 10 days, but most sellers are willing to wait 20 days, assuming your other terms are fantastic for them.
The second part is the appraisal. So if you have a loan, you're going to need to have one of those. No lender is going to give you a loan without knowing what the asset is worth. So if you want to compete with a cash offer, you need to either waive the appraisal completely or do a partial waiver. So waiving an appraisal completely basically says, hey, when the bank sends their appraiser out to give a valuation for that property, you as the buyer don't care what they come up with. So if you buy a house at $500,000, or that's where your offer is, and the appraiser comes out and says, well, we think it's worth $450, as the buyer, you say, well, I don't really care. I'm still willing to buy it at $500. So even if the lender only lends on $450, when you waive appraisal, you're saying, I will come and make up the difference, that extra $50,000. You'll come up with cash, or you'll come up with some sort of terms with your bank so that it doesn't matter what the appraiser says in that valuation.
And that can be really terrifying for some buyers. Some buyers don't even have $50,000 in the first place to put down. So some things to keep in mind. A lot of times you can massage what you were going to do for your down payment to put more of that into the appraisal waiver bucket of what you can make up an appraisal difference. Another thing to keep in mind is that your agent, if they're really good, can send over comparisons and push for the appraiser to appraise as high as logically makes sense. Because honestly, 3 different appraisers would give you 3 different values for the same house. So the seller knows that and knows that if you get a horrible appraisal that doesn't know what the Austin market is like right now, they could say it's worth way less than it's actually worth, and they don't want the deal falling out because your appraiser was bad.
And so here the bank matters a lot, because if you have a local bank who is really in touch with the market and has a local appraiser who knows what's going on and is more in touch and really isn't just doing this all from a query online, then you'll have a better chance of getting a realistic valuation. So again, picking the right lender makes the big difference.
Definitely. And it's also important to keep in mind that appraisers are required to use past sales. So if it closed last month, then it went under contract 2 months ago. In which case, 2 months ago was a very different market in Austin than it is
in the
right
past
this
3
second.
months. This normally doesn't move that fast, but lately it's been really fast.
Definitely. And Austin is anticipated to grow even further. So I've had appraisers hand me appraisals and apologize and say, I know it's worth what your buyer wants to pay for it. Unfortunately, I have to use the appraisal laws that dictate very specific rules around what I can use and how much I can adjust it. So it is not necessary. It does not necessarily mean that the house is not worth, say, $500 when you get an appraisal at $450. It means when you look at things that sold 2-3 months ago, which may have had different factors around their sales and different conditions, that it looks like it's worth $450,000 according to that particular appraiser. So people get really scared about this whole appraisal waiver. And I totally get that. We totally get that. And we would not usually recommend it. Unfortunately, the vast majority of winning offers right now have them.
That are financed.
And so we do have ways to help you fight. We do have ways to try and protect you within that and to try and massage the money to make it make sense. But just know that in a quickly growing market, appraisal waivers and appraisal shortfalls are a thing that happen.
Another idea that can sometimes work is a partial appraisal waiver. So what this does is, instead of, throwing the baby out with the bathwater, you're going to say well, wait a minute, I will waive the appraisal up to, say, $475 in our current example of a house that's purchased at $500, but the appraiser thinks it's worth $475 or $450. You would say, hey, I will waive it up to $475. So now the difference comes down to $25 instead of $50 between you and the seller.
And this can make a lot of sense when you say, okay, we have a grand total of $50,000. We need at least $25 for closing costs and our down payment. But we could theoretically put $25 towards an appraisal shortfall at worst case scenario. So you take whatever the agreed upon price was, you subtract however much you might be able, or you can swing if you had to, and you say, okay, assuming it appraises for $475, we waive appraisal and we will go up to $500. But if it appraises under $475, again, say it came back at $450, you were able to walk away and take your earnest money.
The third issue is the financing contingency. So if you're using a loan, typically you have a contingency that says you have a certain amount of time to get approved by your bank, which you don't have with cash. So how do you compete with that? Well, you can waive the financing contingency, but let me back up a little bit and talk about what the contingency does for you. It's kind of a get out of jail free card for a certain amount of time. typically 18 to 21 days, because that's how much time the lender needs to underwrite you as a borrower and decide, yep, I have blessed this person, thou art credible, and you may now purchase the home, right? However, if you waive that, you're saying like, hey, I don't care if the bank approves me or not, I am buying this home. But you don't want to do that unless you are fiscally strong and you really know that you can get the loan. So if you have that conversation with your lender ahead of time and the lender feels super confident, like, you're buying way below your means, your DTI is really high, as in, actually your DTI is really low, like you're buying a house that's, maybe 20% or less of your income, like, hey, you're super strong for the house that you're buying, then you can waive that contingency. Now, it means that you put your earnest money at risk much sooner, and we have fewer options to get you out of the contract, but it does mean that your offer, even with a loan, is a lot closer to being like cash.
Definitely. And, a lot of times we'll end up calling the lender and chatting through it and asking, how the debt to income looks, how the assets look, how the credit score looks, and how confident they are. Honestly, our lenders in general, they don't pre-qualify you unless they're pretty darn sure that they can get you the loan. So it does risk your earnest money, which we can talk about that in another video. But it is something that makes you much more cash-like and makes the seller much more likely to go with you if they're facing cash offers on the other side. And
the one critical factor of all of your finances really is the DTI. So if you're buying way less house than you can afford, that's going to help you tremendously. So typically the bankers want your DTI ratio about 30% or less, meaning they want no more than 30% of your total income going toward your housing. So if you can get that down to say 20% or even lower, then hey, your DTI is going to look real strong and the bank is very likely to approve you.
Definitely. And most lenders want a 45% or lower DTI. That means if you added up all of your debt payments, including this new house payment, they would like that to be less than 45% of your monthly income. And number 4,
the special one.
The special one is appeal to the seller on a personal level. If they have a bunch of music equipment around their house, mention how much you love music. I mean, don't lie. We're not encouraging you to lie, but present yourself as a person. And this can really affect a seller.
It does.
I've definitely had them come back when there are other cash offers to my financed client and say, we just really like their letter. We want to sell to them. Can they come up to this price and wiggle these other few terms? We want to go with them. So make sure you are doing everything possible to appeal to the seller personally, and make sure that you have a killer agent that is good to talking to the other agent, because a lot of times that will help it too. Because as agents, we prefer to work with agents that we like. So sometimes they'll come back to us because they know that we do good work, that we're reasonable people to work with, and that we just seemed nice to talk to, which is way better than dealing with an agent that's super unfriendly or difficult to work with.
Yeah, and now for extra credit, you can even make a video of yourself. Because in this environment, like, it's hard for people to get homes, and a lot of sellers, they don't want to sell to an investor because like they want someone to have a home who needs to live in it and isn't going to rent it out. So being a human and having a need for a house that isn't an investment property can really make the difference for someone.
Definitely. I would not do that instead of a letter. I would do that combined with a letter. I would write the letter and say, and we would love it if you watched our video, and make that very easy for them to do, because nothing is as personal as
and connecting, it's actually seeing the person, right?
and seeing them in action, seeing that they're real people, and we as humans are designed to become attached to other humans, so it can really help your case.
Thanks so much for watching. We really hope you got something out of it. Please consider giving a like and subscribe if you want to see more videos from us each week.
Definitely. And if you liked this video, then you are probably going to love our smart way to buy a home in Austin, Texas, otherwise known as what to expect when buying a home in Austin, Texas. Thank you guys so much for watching.
We'll see you next time.